Well, the day started with a pretty ugly earnings announcement from Bed Bath & Beyond, but as the day went on, we actually found that the bulls were interested in buying up securities. The Dow actually led us higher today in our four different indices led by Boeing, which is one of its main components. But today in our trade application example, I do want to focus on one of the other four indices and kind of a midpoint area where it's at within a recent sideways trading range. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's April 12th, 2018. Welcome to everyone. If you're new, we'd encourage you to sign up for our YouTube channel by clicking that subscribe button itself. Remember, if you're watching this on the Market Scholars blog, you should also be able to see a floating Market Scholars icon in the lower right-hand corner of your YouTube video. If you hover your mouse over that, it'll allow you to subscribe to our channel as well. Of course, we'd appreciate the thumbs up if you appreciate getting these videos for free on a daily basis. I know many of you do that regularly, and we thank you for that. If you want to leave us comments, you're welcome to do so by scrolling down. And then lastly, we have a description area that would allow you to sign up for our email distribution list, which does entitle you to finding out which stocks in the S&P 500 have overbought and oversold market forecast cluster signals here for the day. We're also heavy users of Twitter. We'd encourage you to follow us there. My handle is @BrandonVanZee, all one word. The Market Scholars handle is @market_scholars, and David Settle is @DavidSettle42. Keep in mind that we'll generally pin our Market Outlook tweet to the top of our profiles, and we would encourage you guys clicking like and retweet. Generally speaking, if we can get 100 likes on a daily basis on that tweet, I view these videos as well worth our time. If we get less than 100, then we start questioning whether we should do these every day or maybe just once a week on the weekend. So if you guys could do your part and click like and retweet on Twitter, that would incentivize us to continue to do these on a daily basis as well. Now, in addition to Twitter, we're also on Facebook. We would encourage you to take note of that web address you see in front of you and join our Facebook group if you decide you want to continue these conversations beyond these videos. All right, with that, let's go ahead and do some analysis on the markets. As you can see, I've got the S&P 500 pulled up in front of us. S&P 500 was up 0.83% today. Now, you will notice that the chart looks a little bit different here today. I want to thank my friend Clarence for helping me out with kind of a new view, a new way to look at these charts here. You guys will recall that in the past, my color background was simply signifying whatever the current posture was, but it didn't necessarily tell us anything about the past. So this new chart setup right here is going to allow us to kind of code into the charting system itself whether we have a bullish or bearish posture right now, and then also where we had those changes of bullish and bearish postures in the past. In addition to that, you'll notice that even the pink, for instance, this pink background right here is a little darker. This one's a little bit lighter, and so that's kind of signifying that crossover point between where we would be weakly bearish and strongly bearish, depending on whether that green line was above 50 or below 50. So some pretty cool effects there in our chart. So get used to seeing that on my initial chart, at least here, when I do my analysis going forward. So as you can see right now, we do have a bullish posture on the S&P 500, and that's why the most recent background color over here off to the right is green at this current time. Now, having said that, notice that where price is in relationship to the moving average is still below that falling moving average. And that's why that moving average line is colored red itself. So while it's good to see the posture flipping back to bullish, we have to remember that prior day it was bearish. And we've had a lot of that back and forth posture changing in recent months. And that's a sign of a choppy sideways market. That's what you get. You remember, like if you were to go back on, let's say, a one-year chart here, then things change a little different. You'll notice that back here, let's say in 2017, the fall, starting in actually late summer, late August here, all the way through about this point right here in November, we had a really long stretch of nothing but bullish posture on the S&P 500. We also had an excellent stretch of time from basically here end of November to end of January with only one bearish posture change along the way. So you'll notice the difference in the back and forth posture changes over here towards the right compared to what we had, which was a really nice period of time for trending bull markets back in 2017. 2018 has been a different year. I think we can all acknowledge that. So let me get back to what my 3-month daily view here. You'll also notice that down below, I do have the market forecast indicator along with the market sentiment line in the orange down below here. And then lastly, I do have a percent change histogram that allows me to see when the market, or whatever ticker symbol, I mean, if you wanted to put in Apple as an example, it'll show you how much the stock of Apple is up or down from a histogram perspective to kind of get a sense of how volatile it might be. So back to S&P 500, you can see with today's movement up at 0.83%, that would be represented by this histogram bar down here. And notice how it's almost up to that blue horizontal line. That blue horizontal line is the 1% level on top. The blue line on the bottom is 1% to the downside. So if the market is ever down 1%, like it was over here, then you'll see these red bars cross into that blue horizontal bar. So anyway, just a different view for you to kind of see how volatile prices have been here recently. Let's go ahead and take a look at our next chart setup, which is our 4-grid here. And this will allow us to kind of see what's going on with all 4 major U.S. indices. And as you can see, we've got green background charts and all of these signifying that the current posture, according to the market forecast intermediate term line, and again, I'll reiterate that the green line is the line that we most often refer to when we're setting our posture. So all of the ThinkScript and coding that's associated with so-called posture is based around that green line. But in this particular case, you can see that we do have bullish postures across the board from an intermediate term perspective. There are a couple of differences in the charts themselves. First of all, notice that we've got a yellow tip to the moving average here, this 30-day moving average on the Dow Jones Industrial Average up here. Reason we're getting that is because price is now above a falling moving average. So those two things are kind of the opposite of one another. When we have price below a falling moving average, those two are heading in the same direction, and so that's kind of the red effect there. And then when we look at the Russell 2000 down here, we have price above a rising moving average, and that's why we now have that moving average color turning green here at the end. We'll be talking about the Russell 2000 here after just a little bit as well. But before we do, let's go ahead and take a look at some other charts. This time we're going to look at the 3 green arrows chart. And as you can see, we've got a little bit of a mixed bag here. 2 of the charts are white background, 2 of the charts are green background. And so what that signifies is that the charts on the left, in this case the S&P 500 and the NASDAQ, have mixed signals amongst its 3 technical indicators that we use for this setup, which would be the 30-day moving average, the MACD, and the stochastics. And so just one example of how that might work, you can see we still have a red arrow on the moving average itself despite having green arrows on the MACD and the stochastic. So that's why we have a mix of green and red arrows, and that's why the background color is white. On the other hand, we look at these charts on the right-hand side. This is the Dow Jones on top and the Russell 2000 on the bottom. Both of those have green background colors, telling us that there is a little bit more positive technical movement into those areas there. We do have 3 green arrows across the board. And again, the key reason for that, if you'll notice on all of our charts, we've got green arrows on the MACD and the stochastics on all 4 of these charts. So really it's just a matter of waiting for price to get back above moving averages to turn on those green lights. And we do have that here with the Russell 2000, and we just barely got it here today with the Dow Jones Industrial Average as well. All right, let's go ahead and take a look at our longer term chart now. Remember, this is going to be our 3-year chart here, and each one of the candles represent 1 week in time. We're getting a little closer to the end of the week, a little bit closer to confirming this candle, because remember, if we are looking at weekly candles, they're not really locked into place until Friday afternoon, but things are looking really good right now. We do see substantial bounces away from the 40-period moving average. Remember, the 40-period moving average on this chart setup is in the black line, and the 10-period is in the orange line. And so when I say we're bouncing away from that 40-period moving average, you can see as just maybe one example, Let's use the Russell 2000 as our example here. I'm going to right click and I'm going to go to maximize sell. Notice that this candle that we have, the most recent one, the weekly candle, looks very strong, looks very bullish. It's bouncing off and away back to the upside off of that black line there. Remember, if you guys use daily candles, that black line would be very similar to a 200-day moving average. So what we're really looking for when we're looking for this system, so-called system, to work or not work, is when we have crossovers of the moving averages themselves. We've certainly had price touching that black line a couple of times within the last few months, but we still have not had that more sensitive 10-period moving average there in gold or orange cross below that black line. And so maybe we get bailed out yet again. It's been over 2 years since we've had a bearish posture from this long-term charts perspective. And who knows, the way things are shaping up this week, it wouldn't be entirely unreasonable to expect continued upside movement at this point either. All right, let's go ahead and now take a look at our sectors 12 grid. And as a reminder, I do need to kill that camera feed here so that way you guys can see every square inch of my screen. The chart in the upper left is going to be your S&P 500. All the 11 charts following it are going to be the 11 different sectors that make up the S&P 500. Now, we did have a big movement in interest rates today. Probably talk about that here in a little bit when we get to our intermarket analysis 12 grid. But most of you are aware that there are some interest rate sensitive sectors that are out there, in particular utilities and real estate, which are the final two graphs or charts on my setup here. Those two generally do poorly if interest rates go up, and you can see that was certainly the case today. On a great day for the overall market, utility stocks were down over 1%, and so were real estate stocks. So it's not necessarily that those areas are having a bad time with profits or anything along those lines. It's basically a macro effect of traders pushing those securities around simply because of interest rates. Well, usually the sector that is on the beneficiary side of rising rates is the financials, and you can see that financials actually led us higher today. XLF right there is 1.75 to the upside. Now its chart doesn't look great, admittedly, but it is a bullish chart. It's back to that green background color, and so we'll see how long that'll last. Remember, this first major week of earnings announcements usually is capped by bank earnings at the end of the week. And so, keep your eye on the scorecard of the various big banks out there and see how they come through. But as of today, they were looking real strong. And again, that was probably a lot to do with interest rates going higher. All right, let's go ahead and take a look at our foreign markets now. And so this is 12 select foreign equity markets out there, major ones, where we can kind of get a mix of countries from all over the globe. And up at the top, you've got your BRIC countries, so Brazil, Russia, India, and China. That's your kind of your emerging markets feel towards these charts that you see in front of you. And we've got kind of a 2-and-2 split there. Brazil and Russia continue to have bearish postures, whereas India and China firming up just a little bit here and giving us bullish postures. The only other bearish posture we have on the board is South Africa in the lower right-hand corner, which is kind of interesting because for a while that was a real outperforming market, but things have changed there and they have not rebounded off of these lows here nearly as dramatically as the others. You'll notice that they're still hanging out towards these lows of the last couple of weeks, whereas you look at its neighbor to the left here, Israel, you'll notice that we have a substantial bounce all the way up to that moving average there. In the case of the United Kingdom, which is a chart that I've been kind of pointing out here in recent Market Outlook videos, notice that the United Kingdom is up and running to the upside as well, crossing above some of these key resistance areas and staying very resilient up there. So that's kind of interesting. And then Mexico has been pretty robust here as well and continued the good times for Mexico here. All right, let's go ahead and take a look at our final 12 grid here, which is the intermarket analysis 12 grid. And you can see what I was referring to before up here. TNX is your chart second to the left at the top. And interest rates were up 1.58% today. And so a pretty robust looking candle there, closing near the highs. Back up at that moving average, and you can see that there is a bullish posture on interest rates at this point. So keep your eye on that, because that's going to be the thing that really pushes your utilities and real estate and financial stocks around. The other chart that I know both David and I have been highlighting many times in the last couple of weeks has been in the lower right-hand corner, which is crude oil. Boy, just very, very resilient there with crude oil here recently. A lot of those stocks perking up very nicely as well. If we want to take a look at what was going on here from a sector perspective just today alone, there it is once again with the financials up at the top and the utilities and the REITs down at the bottom. So that's kind of the way that it should shake out if interest rates were up substantially like they were here today. Now, one of the more cyclical areas out there is consumer discretionary, but you'll notice that consumer discretionary was actually the 5th worst performer today despite the bullishness in the market. One of the key reasons behind that may have been that earnings announcement that I mentioned in my intro with Bed Bath & Beyond. And just as a quick reminder, for those of you that follow me on Twitter, first of all, if you're not following me yet, again, my handle is @BrandonVanZ, all one word. Just click the follow button. But every morning at 9 a.m. Eastern time, I do put out a quick little snippet on which stocks are most likely to be affecting the markets that particular day. And so on today's graphic, we did have Bed Bath & Beyond right there. You can see it was down 16% prior to the market open. Remember, that graphic gets produced 30 minutes before the market opens. But things got even worse for Bed Bath & Beyond as the day went along. So if you look at Bed Bath & Beyond right here, notice that despite plunging 16-17% to gap down the day, it still ended up pushing even lower throughout the rest of the day. Ended up closing down nearly 20% at this point. And of course, that's going to pour over into a lot of other retail names. So I'd have to believe that part of the reason that your discretionary stocks did not outperform the S&P 500 on a bullish day is because of that carryover effect from Bed Bath & Beyond. All right, so for today's trade application example idea, I'm going to go over here to just a regular chart here, a 3-month chart. And I'm going to pull up IWM. So this is the Russell 2000. Most of you are quite familiar with this particular ETF. It's one of the more popular ETFs out there, one of the most liquid ETFs out there, which is an important concept for the particular trade that I'm going to discuss today. The trade that I'm going to look at is selling an iron condor on IWM. I sometimes like these types of trade setups where you've got price, as you notice right here, here's our price candle for the day. It's almost exactly between the most recent high and the most recent low. We're basically straight in the middle of that. And I think most of you can recognize that for the last 3 months, this looks like a largely sideways chart. And if you can't see it with your own eyes, one other way to kind of understand that and absorb that in your mind when you're looking at my charts is just look at the changes of the moving averages themselves. Red to yellow to red to yellow to green to yellow to red to yellow to red to yellow to green. That doesn't happen when you're in a trending market. That happens when you're in a chop and slop sideways market where the market can't figure out where it wants to go. So one way to take advantage of sideways markets is by selling an iron condor. So that's what I thought we would do today in the example. So let me go ahead and pull up a trade tab here. And I've got IWM pulled up in our trade tab, and I'm using the Thinkorswim Paper Money platform here for this discussion. And what I'm going to do is I'm going to go out to the May contracts with 36 days until expiration. Now, one of the things that you want to stress when you're looking at iron condors is liquidity, as I mentioned before, but this is one of the most liquid securities out there, so we really won't have an issue with that here today. The other thing that I will point out regarding focusing on ETFs is something I brought up on Tuesday, which it depends on where you fall on this side of the debate, but when we go into an earnings season like we have just started here this week, And if you have a rule that says you don't like trading options through earnings announcements, it can be a difficult time to find proper setups. And so remember, one of the things that you can do, rather than trying to go through 500 common stocks to find just the handful that don't have earnings coming up in the next couple of months, one of the ways that traders kind of rectify that idea in their head is they go back and they just start trading the ETFs a little bit more. Remember, ETFs do not have earnings announcements, since they're a basket of a whole bunch of securities, in this case 2,000 small cap United States based companies. So with that, let's go ahead and get our trade set up. So what we like to do on the iron condors is look for a 20 delta. And so we do have, you can see a 19 delta that I'm kind of circling with my mouse here, and that would lead us to the 161 strike in May. That's your call side of the equation. That's the one that we're going to sell. We're going to end up buying the 163. I like to do $2 wides in this case to kind of be more efficient with our capital and with our potential commissions that would be involved as well. So we're going to do a $2 wide bear call spread, starting with a 161 that we're selling, and the buying leg of that is 163. On the put side, so now remember the iron condor, the idea is you're selling credits on both the top side and the bottom side of where that particular security is trading at this time. In other words, you're betting that the stock, or in this case the ETF, continues to go sideways. You're not betting that there's going to be a huge breakout up or a huge breakout down. If that's the case and it stays in this sideways channel through our expiration date in May, then we should end up winning this trade. And so kind of the same thing on these ones where we're doing iron condors. I'm going to specifically locate a 20 delta if I can find it. Well, this one's a 19 delta again on the put side, and that leads us to the 147 strike on the put side. So we'll be selling the 147, buying the 145. So with that, let's go ahead and load up the trade. I'm going to come back over here to the call side and go to the 161. I'm going to right click. I'm going to go to sell iron condor right there. Now that's going to load up our trade down below. And we will have to make some adjustments here. Remember, this is going to be 4 legs in this particular trade, so that's why that liquidity is essential for this style of trade, especially if you're planning on getting out of this, managing your exits, so to speak. So with this, let's go ahead and start making our adjustments. The 161 where I clicked on it originally is set correctly. So that's good. We don't need to change that 161 right there. But as I mentioned before, I am going to change the 162 bought strike, which you can see is bought over here because it's got the +1. So that's your second line. I'm changing that to 163. Okay, so this call spread, you can see that these two right here in the type, it says call. This thing is established the way that I want. I'm selling the 161 call. I'm buying the 163 call as kind of a built-in hedge against being short the 161 call. So that part is established. Now we need to work on the put spread, which is set up down below. Now this one, you can see the sold strike is kind of the third line of this group. It says the -1 in that particular case. Coming over here, it says by default 160, but that's not the trade we want to do at all. It's not even close to the trade we want to do. So we have to click on that and then select whatever strike it was that we had selected, which in this case was the 147. And again, we selected that because that was the 20 delta. Now on the bottom line where we have the +1, where we're dealing again with the long put in this case, remember in this one we would go 145. So again, the same concept holds true where we have a bull put spread that's embedded into this iron condor trade. Whoops, hang on. I didn't click the right one, did I? There we go. We have a bull put spread kind of embedded into this iron condor trade where we're selling the 147 put on the downside, meaning that we'd be willing to let IWM go from 155 right now down to 147, but if it plunges, let's say the stock market goes into a nasty bear market in the next 36 days and this thing's at 140 at the end of the expiration period. That 145 bought put is for our protection. We would still end up losing money on the trade, but we wouldn't lose incremental amounts of money the further that the price went down. So remember, on the outside ends of those iron condor trades, those are really our built-in insurance contracts to kind of offset the sold premiums we're getting when we're selling puts and calls in between. So that is kind of what I wanted to get set up there. Notice where our credit here is 55 cents. So if we wanted to figure out what our return on risk was with that, what we would do is, first of all, I'm going to click confirm and send just once to get the numbers. And then I'm going to look at the calculator. I'm going to take 55 bucks, which is our max profit here, divided by 145, which is our max loss. And that tells us that our return on risk is about 37, 38%, somewhere in there. Anything above a 30% return on risk is of interest to me. Now, if we were to kind of take that one step further and kind of visually highlight where our break-evens would be on this trade, remember what we would end up doing on the put side. So if we're selling the 147 and we're getting a 55-cent credit, we can basically figure out what our break-even is on the downside by taking that 147 minus 55 cents a premium we're going to receive up front, and our break even on that trade is 146.45. So as long as it doesn't go below there, we should end up making some money on this trade, or at least that's kind of your assumption going in. Now, to figure out the break even on the other side, because remember, this iron condor features two different sides to the trade. It's not like these normal credit spreads that we will sometimes show you in these videos where you only have one break even price. Here in the iron condor, you're actually going to have two different break even prices, but the stock can only be in one place at the expiration date, so there's no way you can lose both max losses on both sides. That's kind of one of the nice benefits. But anyway, if we're going to do the break evens on the call side, what we're going to do is we're going to take the 161 call and add, this time rather than subtract, add 55 cents, which is our premium. And there, of course, our break even is 161.55. Now, some of you might want to take this a step further and come on over to the chart here and just type in whatever ticker symbol it is that you're dealing with and make some drawings of your own. So what I'm going to do here is I'm going to come up here to drawings, and I'm going to go to let's go to just a price level. We'll just do two different price levels. By the way, you can do this through the Analyze tab as well. I've showed you guys how to do that plenty of times, so I'm just showing you an alternative way of looking at this right now because I know sometimes people get a little bit confused when they go over to the Analyze tab if they're not as familiar with it. So remember, you can actually manually draw your lines almost as easily if you so desire. So that's what I'm highlighting right here. So I'm just going to draw a horizontal line by clicking once and then clicking one more time on the chart. That locks in this line here for me. Now I'm going to right click on that line. I'm going to go to Edit Properties, and then I'm going to change this value right here to 161.55. Remember, that was our break even on the upside of this iron condor. I am going to change the color of this. Let's go purple on this. Let's go kind of dotted line, and let's go a really big width there of 5, which is the most width that you can have, and it's going to really make it stand out on the chart. Okay, with that I'm going to hit OK, and you'll notice that our upside break even is way the heck up here on IWM. So in other words, the stock would have to go from here, breaking out above this double top before our break even on the upside is threatened. Let's do the same thing on the downside. In fact, since I've already done the kind of the enhancements to the line, what I'm going to do in this case, rather than starting with a drawn item, I'm just going to actually duplicate this line here. So I'm going to right click on the line. I'm going to go to duplicate drawing. That then kind of sets up another one. It's kind of hidden there, and then you could drag it out of the way. And I'm going to get it down there pretty close to 146 if I can, somewhere in that neighborhood. There we go. And then I'm going to lock that into place. And then I'm going to get very specific with the number itself by right-clicking on that, going to Edit Properties. And in this case, I'm going to go to 146.45, which again was our break even on the downside. So you can see how this is set up right now. This is a one-year chart that we're looking at, but clearly in the last 6 months, probably 85% of all instances of price action have occurred within our bands itself. That's again one of the benefits of putting on a trade like this when it's at its midpoint in that sideways channel. So you'll notice in order for us to be threatened on the downside, this market would have to reverse course, go lower, and actually cross below where our low was on April 2nd before we were threatened. Now, if it does get down to as low as we were trading back in February, we are going to be in trouble on that trade. So you have to make sure that that is okay in your mind. But generally speaking, this should be a higher probability trade for success right here. I'm going to come back over to our trade tab. I am going to kind of make this a little bit more meaningful than just one contract. I'm going to do 10 contracts in this particular case. So I'm going to click on confirm and send, and we'll go ahead and fire that off and see how we do. All right, I want to thank you all for joining me here tonight. Always a pleasure to get a chance to go to work for you. Another good day in the market, so a little bit of consistency there for the bulls here, which is nice to see. Good change of pace there. We did have a couple of landmines in the form of some retail earnings today, in particular Bed Bath & Beyond. But we've got the financial stocks here that hopefully can pick things up for us from an earnings perspective here at the end of the week. Remember, the interest rates did go a lot higher today, so expectations of future hikes likely going higher as well. That will generally help your banks and your brokers, generally hurt your utilities and REITs, at least in the near term. So with that, I want to wish you all the best with your trades and your investments. I'll be back with you next Tuesday. David will be with you tomorrow, and I want to wish y'all a great weekend if I don't talk to you before then. Take care, everybody. Bye-bye.